Yeah, hello. Welcome back again to a video on international taxation. We have up to now spoken about the deduction method and the credit method. And naturally, as you probably remember, all the cases we dealt with were cases of unlimited tax liability because avoidance of double taxation is traditionally a task of the state of residence where you are subjected to unlimited tax liability. Now, as most of you do not have a deep knowledge of the details of German worldwide income taxation, let me mention now a small excursus on the treatment of foreign losses when it comes to the computation of the worldwide income. This section is now about German law, naturally, so what is the special situation concerning losses when it comes to the worldwide income in Germany? You can find the relevant rules in section 2a of the EStG. And what we need to know first is that many countries have an interest to tax the worldwide income, but to, let's say, ban or exclude losses from certain foreign investments from the computation of the worldwide income. The background of such a rule is very often that one wants to avoid, well, losses for the own tax revenue from investments or activities abroad. Nevertheless, profits from such investments will later be taxed. So when you suffer a loss from a certain investment abroad, the loss will initially be completely disregarded, so you take it into account with an amount of zero, and later profits from the investment will count as taxable revenue. However, it would be a bit, not only a bit, but it would be strongly unfair if you exclude the losses completely from deduction and then later tax the complete profits. So the compromise, at least the one which is done in German law, is that it's usually allowed to deduct the former losses from the profits which come from such activities in later years. So when the profits are taxable, then you can deduct the losses, but only then. That means, to sum it up, at the moment when the losses occur, no relevance for the computation of the worldwide income. These foreign losses are set or taken into account with an amount of zero. However, later, when, or better if, profits occur from that foreign activity, then and only then the former losses can be deducted from only these profits. So you see already a certain risk when you make a foreign investment. Make a loss and the thing completely fails so that the profits never come, then you will never be able to deduct the losses. That means that paragraph 2a regime sets up a very unfair treatment for foreign investments. If it goes wrong and you make an overall loss, then the loss will be ignored. So if you make a foreign investment and it fails, it's your personal problem. You cannot set it off from the tax base. You will have to recover the lost amounts of money from your taxable net income in the inland. And usually imagine, depending on the tax rates, if you suffered a loss of 100,000, you need to earn a gross income of 150 or 200,000 before you can set off a net loss of 100,000. In the inland, that would be different. If you risk an investment, it fails with 200,000 in one inland investment, the only thing you need to do is to earn 200,000 gross from another investment, and so you have recovered all the losses. So the economic consequences are strongly different. Well, again, to sum it up, if you invest in a foreign house and first have losses of 10,000 in year 1, you will have a completely ignored loss in year 1. When in year 2 you have a positive income of 12,000 from that house, you can then deduct the former losses from the revenue from that house, so that in that year you would have, in my example, 2,000 euro taxable profit from the house. In Germany, you find this basic rule for foreign losses in paragraph 2a, and so we should perhaps have a look on the legal text. This is again my translation. No guarantee that everything is exact. This is only to give you a rough first impression of what the law says, as always. It begins with negative income from, and then a list follows, from an agricultural or forestry permanent establishment in the third state, or from a permanent establishment in the third state which runs a business, or from an impairment due to a lower partial value of a share in a company of a third state, or from the alienation of withdrawal of a share, and so on, in cases of paragraph 17, so selling shares in foreign companies, or from a participation in a business where you are a silent partner, or, that is our case from the example, from lease and rent of immovable property or of a multitude of things if these are located in a third country, or from or can only be offset against income of the same kind, and with exception of the cases which are named in letter 6b, from the same state, in the cases of number 7 on the blah blah. So you are not allowed to set off these losses under paragraph 10d, so they are not allowed to enter the loss carry forward, the usual one for the worldwide income. They will be treated separately also for future years. Sentence 3, as far as the negative income cannot be offset under sentence 1 in the same year, that's what is meant, these losses lower the positive income of the same kind of the taxpayer from the same state and usually from the same kind of activity. Offsetting the negative income is only allowed in future years as far as the negative income could not be offset previously, and the amount which remains at the end of the year of the negative income which has not yet been offset shall be fixed by a separate administrative act, by this administrative decision. Well, so you carry forward all the disregarded losses from a certain activity until the losses have been recovered by profits from that activity in that state. Well, such a rule that foreign losses cannot be offset brings up certain questions. First, why does it exist? How is it done? And why is it, in our case here in 2a, restricted to losses from new non-EU countries? Well, let us have a look to the first question. Why are certain losses from foreign countries ignored in the computation of the worldwide income? Well, you know that people always have the inclination to save taxes. You can save taxes by, well, investing to tax-free investments, or what also brings in relief is to invest money in an investment which at the beginning produces a loss, which you later recover. Because imagine you have now an income of 200,000 from one source, but you can now add income from another source amounting to minus 200,000. Then you have this year a total income of 0, and this year you pay no taxes. Only years later, when the minus 200,000 are recovered from the other investment, you would in the end then, let's say, have a profit of 201,000 to tax, and so you might shift profits to the future by such an investment project which at the beginning creates losses and later generates compensating profits. Now, Here, just to make it clear how it works, again, a current income of 100,000 do you have each year. Now you invest into a hotel or something similar that brings a loss of minus 100,000 now and a profit of 110,000, but only in 10 years in the future. So your present day income goes down to zero. You pay no taxes this year. You will only have a positive profit in 10 years' time. And well, that's a tax saving effect. Now the hotel sector profits from your willingness to invest because you will probably be willing to invest there even if the conditions for an investment are not so fine as if you place it in a bank account, because here you get that tax saving effect. Yeah? So probably the hotel sector, if it's able to generate such losses first and then profits later, has lower capital costs just due to the tax effect. And that is why the legislator sometimes said, well, we want to fight against these loss-based tax saving models. And at least that was an idea in the 1980s. At least we are not willing to finance by the tax saving effect all the investments in hotel buildings abroad. It is worse enough that we finance nearly every hotel building in the inland. We do not need to do this abroad. And so there was a list set up which investments in foreign states were regarded as detrimental or at least not as favorable investments. And so for all these losses put on the list, the legislator decided these losses shall be eliminated from the tax base and treated under the rules of 2A, so that you have to pay taxes when the project has a positive outcome, but when the project fails, you can't offset it from the tax base. Now, well, let's again look on how it is done. Certain losses from abroad in the list of 2A, we saw that before, can only be offset against income from the same kind of activity, and it must be in the same state. So basically, if you do not invest very much in one single state, that means you can only offset the losses from a certain investment against the profits coming from the same investment. That's a bit simplified, but that's the basic nature. So if investor B has expense of minus 30,000 from a house in a foreign state X in the same year, that is banned from deduction. No, in principle. But if the investor has revenue from the same house in the same year of 10,000, the expense can be set off against the revenue. The total result is minus 20,000 for this year. These 20,000 cannot be added or taken into account as a part of the worldwide income in this year. You can only shift these 20,000 to the future. And that means if the house brings a revenue of 25,000 next year, the 20,000 loss from the first year can be deducted from that, resulting in a taxable amount of 5,000 for year 2. You see, in the final effect, that means when you reach the break-even point with a foreign project, then you are regularly taxed with your total gain or profit from that activity. But if you do not reach the break-even point, the consequence will be the loss cannot be offset. So you bear the full risk on your own, whereas if you make a profit, the fisc and you have to share the money as usually. Now, this relatively unfair approach motivated the representatives of the economy to protest or to lobby in their interest and to say, well, certain foreign investments are necessary. We must take the risk to invest there. And if that fails, paragraph 2A would make these investments economically more expensive than they were without that loss restriction. And so they convinced the legislator to make an exception and to say certain foreign losses are although they are on the list of 2A of these suspicious losses, which can be banned from the worldwide income, certain losses will be reactivated and they will be treated completely regularly, again as a part of the worldwide income in the year when they arise, so that you have no problem at all. The regular rules apply again. These investments are sometimes called active activities, so genuine economic activities done in a bona fide motivation not to save taxes. And the law defines that a foreign permanent establishment can be treated regularly if it exclusively does activities on this list here: production and trade, search for mineral resources, or services. However, there are some exceptions where the legislator says, well, certain activities, even if they are in this area, will be regarded as detrimental to the loss consideration. Certain losses, therefore, even if incurred by a foreign permanent establishment, will be banned from deduction. So we end up with a two testing steps approach for foreign losses. Step number one: is the foreign loss excluded from deduction, excluded from the worldwide income by paragraph 2A1 EStG? And if that is the case, then we make a second step of testing the law. If 2A1 applies, is the foreign loss then reintegrated into the worldwide income, so treated again completely regularly by 2A2. And what this says is here on this slide. 2A2 says that paragraph 1, sentence 1, number 2, so the ban for the loss deduction from a foreign permanent establishment, and only that, is not to be applied, so that the regular treatment applies again, if the taxpayer proves that the negative income originates from a permanent establishment in a third country, which exclusively or nearly exclusively does the following activities, and then blah blah. Now we can even mark these good and bad activities according to a traffic light, because we should use red for that the loss is stopped and cannot enter this year's tax declaration, or green for the way is free for the loss, it is treated as regular part of this year's worldwide income, so it can be taken into account. So if you highlight in green the relative things, then you see that paragraph 1, number 2 only can get a favorable treatment, losses from a foreign permanent establishment, and that it requires the green highlighted activities: manufacturing or delivering of goods, mining of natural resources, or the rendering of services, so everything which a usual business can do, with again the exception of certain things which are regarded as rather shameful or suspicious of being a tax saving model, that is, apart from delivering or manufacturing weapons, or apart from the construction or running of locations which serve tourism, so hotel areas mainly, or the letting for rent of assets, including the letting of rents for rent of rights, plans, musters, experience, or knowledge. Both things are suspicious of being used for tax saving models, so they are banned from deduction. So here 2A1 would regularly apply, the loss would be banned. The green things lead to, however, regular treatment of the losses. If you hold a participation in a company which does the same thing, and you have losses from that participation, for example, by an impairment which you have to make on the participation, then you also have a similar rule. Now, third question: why is the whole approach of paragraph 2A restricted to investment in non-EU countries? That is rather simply to answer, because the EU treaties forbid the discrimination of investments or economic activities in other EU states. And so just crossing out a loss from deduction with the argument, well, it's not from Germany, that would be a clear discrimination of investment abroad. And so paragraph 2a does not comply with EU law. It's a direct contradiction to what we promised in the EU treaties. Now, when that was decided by the European Court of Justice, the German legislator just responded, okay, so for the EU, we can no longer practice paragraph 2a's rules, but we never promised anything to countries which are not a member state of the EU or which are not a member state of the European Economic Area. So finally, paragraph 2a, section 2a, got the following definition for a third country. Third states, in the sense of paragraph 2a, are the states which are not member states of the EU, and companies of third states are such which have neither their place nor management in a member state of the EU. And then those states of the European Economic Area are treated exactly like member states which have an agreement with the Federal Republic of Germany on an exchange of information for tax purposes that is comparable to the exchange of information which is obligatory between the EU member states. So, to sum it up, losses from a foreign country are sometimes banned from deduction in Germany just because they are foreign. So the loss will not be a part of the worldwide income. It is completely disregarded, even in the application of the proviso safeguarding progression, something which we learn about later. They are completely ignored. The only thing you can do with the 2A1 losses is to deduct them from later revenue or profits from the same investment or kind of investment in the same state. Apart from the cases where 2A2 says, okay, forget it, we grant regular treatment to certain losses on the list again, that is 2A2, but only relevant for investment in permanent establishments abroad, which are serving a business activity. There are then to be distinguished the green and the red activities. The green ones are the active ones where you get regular treatment. The red ones, you get the red light, and there the deduction is stopped definitively. There 2A applies, and you can only carry forward the losses to later profits from the same activity. And last but not least, that is what you saw here. The whole maneuver can only be done for activities outside the EU and outside the EEA, because there we have the principle of non-discrimination of foreign investments. So there we can't just ban a loss because it is not from Germany. Okay, this may be sufficient for this time. Keep in mind that this 2A only applies to part of the worldwide income abroad, which means necessarily that in order for 2A to become relevant, you need somebody who is taxable with the worldwide income, not a limited taxpayer. Okay, that was enough for this small video. Thanks for watching this, and hope to see you soon again. Recommend the channel to others if you like the channel. Recommend it to others too if you don't like the channel, and then enjoy if others fall into the trap. Okay, thanks for watching. Goodbye, till next time.